Yeah, now recording is started. Okay. Okay. Good evening once again to everyone. Yeah. This week we will see more about financial aspect of the portfolio management. Specifically, today we will focus on basic financial literacy of what is like ROI and NPV and all that. Then tomorrow we will see more about costing or cost of poor quality, COPQ, cost of poor quality, and decisions based on the costing tomorrow. So we will see financial basics for portfolio decisions. Initially, we'll see basic concepts of these financials, and then we will see later on how we are taking decisions based on our understanding of that financial literacy. So financial literacy, it forms the basic, like it forms the bridge between project language and business language. From if you are saying from is it a good idea to does it create value? We are just moving from idea to value, but based on the financial understanding of our project. Yeah. Then maybe a leadership team or the sponsor team of our organization they rarely approve the project because maybe the scope is attractive or maybe a new market entry something, but mainly they take the decision based on that understanding of that financial uh, investment strategy. Yeah. So the purpose of this session is not like to make everyone a financial expert or maybe purely accounting terms, but to understand the basics to make better decision. That is why we are understanding the financial aspect. Why do we need financial fluency or financial literacy? I'll say with an example. Yeah, if we have like two or three programs in our organization and all are having like some equal importance, or it is technically sound and very good projects, then our organization cannot fund all the three projects together. So which gets priority, or which is the one need to do the first one, which need to be funded first? Then we need to understand the financial basics so that we make a more clear, better, efficient decision. So that is why we need to understand what creates value, or what gives like a payback time for that project faster, or supports our strategy better. So in order to understand that one, we need to have the financial fluency. So projects compete for limited capital, resources, and leadership attention. So our understanding of that financial concepts, this converts technical option into comparable business choices. A good portfolio decision require value, timing, risk, and strategic fit, not only cost. Cost alone, it does not make any decision for that. And finally, finance is a decision language, not just an accounting exercise. Just from our leadership perspective, we need to see it is used for as a decision language, not just an accounting exercise. Then where this fits before portfolio financial tool, we will see portfolio financial tools in the later session. our class. But in order to go there, first we will understand what are all the basic terms and some formulas. We no need to keep everything in our mind, but we need to understand if there is an NPV or if there is an payback term, then we need to easily connect with how it is used in our decision making. So next, then we will apply them to project business cases and our investment request. Then we will compare projects at portfolio level using budget, forecast, risk, and value. Then finally, we'll go for the monitoring of benefit realization after projects are approved. So here mainly we need to have a strong foundation of our finance literacy. So if we can understand what is ROI, return on investment, what is NPV, net present value, or internal rate of return, IRR, payback period, cost baseline. So these are all some basic terms we will understand in our subsequent slides. So we'll move to the next. So basic of the financial literacy is like time value of money. This is important. How we are saying is like, for example, there is a proverb we have, bird in the hand is worth two in the bush. Yeah. So money today, we are having that money is worth more than the same money which is available at later point of time. For example, 1,000 rupees today in our hand is more like it is better than 1,000 rupees after maybe 1 month or one year. So that is the same concept as like time value of money. Money today is worth more than the same money later. For example, in our business, 100,000 received today is usually better than 100,000 received 3 years later, because organization can use it immediately. This is the main time value of money. We need to connect this with our projects, like the benefits that arrive far in future are less compared to the benefits arriving right now. So based on that, we can make decisions. So in order to understand the time value of money, we need to see that present value and future value. Present value means like it's the value of money today in compared to that of future. PV is the present value, FV is the future value. It can be like derived directly using a mathematical formula, that is present value is future value over a rate of interest with a period n. So for example, if 110,000 is expected in 1 year, that means future value. If future value FV is 110,000 and then discounted rate, like rate of interest or rate of discount, we can say at 10%, then what is the present value means? Present value is like 100,000 today. I think this is very easy, simple mathematics, right? Present value means future value over rate of interest and the period. So why we need to know the present value and future value means this gives the direction, like which project gives benefits over at a different point of time. So at a different point of time, which is having more value, we can understand from this present value and the future value. Then cash flow basic. We need to basically understand where the money comes from and where money leaves. So cash inflow and cash outflows. The difference between the cash inflow and outflow is the net cash flow. So cash flow is the movement of money. For investment decision, cash timing is often more important than profit. One example is a software automation project may send 300,000 in year 0, then save 120,000 per year from year 1 onward. That means we have a net cash flow at the end of one year will be 300,000 minus like 120,000. So we can see how the money moves. Cash flow, it's a cash flow basics. What is capex and what is opex? Capex is the capital expenditure, whereas opex is the operational expenditure. Capex, capital expenditure, it is which is invested money on long term assets, usually approved through investment governance. It is often depreciated over time. For example, new production line coming in our organization, that can be a capex. But in the same production line, if we are doing day-to-day activity or maintenance, then it will be coming under OPEX, operational expenditure. Operational expenditure or day-to-day running cost. This is usually hits that current budgeting period. Like for example, normally organization have an OPEX for a quarterly or a half yearly or an yearly expenditure expenses. Some examples are maintenance, some licenses, contract support, training. This all comes under the OPEX. We need to understand the difference of this classification. This understanding gives better clarity of how we can make decision of our immediate requirement. For example, buying a machine can be a capex, but maintaining that machine, it can be an opex. So we can understand how it works in our business. Then budget, forecast, and actual. I think mostly everyone knows about this budget, forecast, and actual and variance. Budget is the approved financial plan. How we are using is setting the funding limit and how we are controlling from that. Forecasting means we are expected future outcome during that period. It shows whether the project portfolio is likely to land. For example, in 6 months' time, how much the project will be completed, that can be given as a forecast. But for budget, we will be based on that milestone achieved, we can allocate the budget for that project. Actual, what is the actual means? Actual, the how much money we have spent it actually from the forecast. The difference between the actual and forecast is the variance. We can use it for the budget as well as for schedule also we can use for variance. So basically the budget says what was approved, forecast says what we now believe what will happen at some point of time. So we will know how much we are spending and how it is be forecasted, this one. Then moving to the profit, margin, and contribution. We all know profit is the revenue, how much we are selling and how much it costs. The difference between the revenue and the cost is the profit. And if we want to know the margin, then profit by revenue into 100. For example, if we are getting a revenue of 1 million and the cost is 750,000, then it gives overall profit as 250,000 with percentage of margin, say as 25% margin. So profit means the absolute result, margin shows as a percentage of that revenue. This is a basic financial concept. I think everyone is aware of this, but just we are reviewing that one. Then break-even point. Break-even point means the volume, number of how much the volume need to be like executed, like before the project or product starts covering its cost. So we can say break-even is a risk discussion. Like how much we need to sell it in order to just cover our cost. If we are seeing with an example, we have a fixed cost of 200,000, selling price of a product maybe 100 euro, then variable cost is of 60. The total contribution is like 100 minus 60, it is 40. So 200,000 divided by 40, that gives the break even point. We need to sell minimum 500,000 unit, then only we achieve the break even unit. That means we are covering the cost only at the 5,000 unit. Then we are moving into the profit zone. Until then we are not even covering that cost. So break even unit is, we are how confident are we achieving that with how much of volume we need to sell or need to serve. So maybe we can say about financially fragile. If the break even point itself is not achieved, means it is already, the project is on low or a negative value, we can say. Then what is ROI, return on investment? Return on investments is a total net benefit over investment cost into 100. Example, investment of 500,000, if we have a net benefit of 150, then ROI we can consider as 150 by 500,000 into 100, that is 30%. So why do we need to know ROI? This metric, ROI metric, is one of the most familiar metric, we can say. We can use an ROI for a quick comparison. If one project is having a ROI of 10% and another one is having an ROI of 30%. So if we are comparing only ROI, then we say 30% is more, we are getting more on our investment return. So we can select that project. So ROI is, we are net benefit over how much investment cost into 100. It gives that ROI percentage. It shows how much return is generated compared to the investment required. Payback period. Payback period, we can say it is a ratio of initial investment to the annual net cash inflow. For example, if we have an investment of 400,000 and we are having an annual saving of 100,000, so how much time we need for getting into that payback? It is 400,000 divided by 100,000, that gives 4 years. So in 4 years we will have our initial investment cost recovered. So payback shows how long it takes to recover the original investment. It is useful for liquidity and risk discussion. Here we are understanding that there is no assumption of any discount here, but this may not be in realistic terms. It cannot be that way because we have always discount. So for that purpose we are using discounted payback period. Discounted payback period is time to recover investment using discounted cash flow. For example, here a project may back in 4 years using a simple payback, but in actual terms we get 4.8 years when use cash flows are discounted. So this discounted payback period is this improves normal payback by considering time value of money. So later cash inflows are reduced to today's value. So normally if we don't have any discounted terms, then we use a simple payback. But if we know the discounted rate of how much we need for that discount, if we have that discounted rate, then we go for that discounted payback period. It is especially used for long-term projects, long cycle projects, such as for maybe for an infrastructure, a railway, or an industrial asset, or a digital transformation program. So discounted payback period. Then NPV, net present value. Net present value is the summation of cash flow over a period of time to the initial investment. Example here, if a discounted benefit total around 650,000 and then investment is 500,000, then NPV, net present value, is 650 minus 500,000. So that is 150,000. So NPV tells us how much value a project creates today after considering investment cost and discounted rate. So this is one of the most important metric we need to have. We need to understand about our projects. So NPV, present net present value, is one of the strongest investment metric. Positive NPV is always expected to create value than the required return. So if there is positive NPV, then we go for that project. A negative NPV means it destroys our value financially. If we have a NPV as negative, then it is not considered as a strategic investment strategy for our organization. Unless if it is mandatory or a compliance perspective or a legal or environmental. If it is like mandatory, then we are doing that project. Otherwise, if it is need to be a strategic investment, then we are seeing only the positive NPV projects. NPV decision rule. Yeah, we are accepting the project when NPV is greater than 0. So that means if it is positive, then we are accepting. But in case of, for example, compliance or legal or environmental, then it will have, even though we do not wanted to do that, but we need to do as based on our organization's continuous operation. So the bigger the NPV is better for us to make a decision easier. Without so NPV supports value-based decision. It helps compare projects with different cash flow timing and investment level.
Sir, one doubt, sir.
Yes, sir.
Sir, if a project has got a net present value of higher,
Yeah.
which promises future returns. However, there are challenges relating to environmental clearance or some
Yeah.
legal compliance or some product risk or dangerous material or things like that. So how do we compare the project feasibility with respect to NPV, which is positive, whereas the actual feasibility with respect to the negative parameters is a little negative?
Yeah, that is why, sir, even though we will see like apple to apple comparison, sir. If we have two projects, which company supports both the project, then we check both the NPV. We also check for the other things such as risk or affordability or the resource constraint. We all check that one. Then based on that one, we give one criteria for this. So
Okay.
we have that priority, no, sir. If we get this criteria one criteria higher, then we go for that project. So again, example here, a project A has an NPV of 80,000, project B has an NPV of 300,000. If risk and strategy fit are similar, B creates more value. But for example, if project B have more risk and more like it is not strategically fit, still a company or organization can go with the project A, because in project B we will have more risks and higher like strategic fall. Is it making
Right.
sense, sir?
Yes, sir. Yes, sir. I mean,
Unless it is
along with,
compliance or
yeah.
legal or an environmental strategy based on our organization, we
Hmm.
we we if, we will fix every other assumption like risks, our strategy, all we are keeping as a constant, and we are checking only NPV. Then we are comparing apples with apples. Then we can
Right.
see which have more NPV, like higher the NPV, better the value we are getting. So we will choose based on that.
Got it, sir. Yeah. Thank
Yeah.
you. I mean, this is one of the criteria, basically,
Yeah,
as
one of
you
the
rightly
criteria.
put it.
That
This
is
is
why I'm
also the
saying
criteria. Yeah.
we have like some financial concepts. We
Yeah.
need to like at least we need to able to remember like what is this, then why we are using it. That is the important of this financial literacy, like basic understanding
Yeah.
of how we can make a decision for our portfolio.
So we are not converting one of the constraints like an environmental clearance or any of those things as they are. We are not converting that into an NPV value or anything. But
Yeah,
that is a risk, and you have a strategic valuation, and then NPV as a financial constraint. And if all of these qualify, then we might go for a project.
yeah, correct, sir, exactly.
Yeah, yeah, yeah.
So again, one
Got
more
it, sir.
concept is internal rate of return. Internal rate of return means it is discounted rate where NPV is zero. Like for example, IRR is the expected annualized return rate of a project based on its cash flow. Example here, if a project has an IRR of 18%, IRR is always expressed in terms of percentage only. If a project has an IRR of 18% and company's required return is 10%, then it appears financially attractive. So in order to have a positive effect of this one, we need to have minimum that percentage, like 10 percentage here it is mentioned. So if it is 11 percentage, the project is okay. If it is 18 percentage, product is very good. So we will go for a higher the IRR. We take that on as our selection criteria. So basically it is what it's saying is it is not extra cash, but it is a percentage return implied by the cash flow pattern. That is the IRR meaning. It is not an extra cash, it is the percentage, it is expressed in percentage, and this percentage return implied by cash flow. So we need to make like for example, for one project if we are taking NPV, one project if we are taking IRR, then we are not comparing equally the project. If you are taking for the project A NPV, then we need to convert that project B also in terms of NPV. Then we can make a better decision.
So this
IRR,
IRR is basically a policy matter of company, whether company can fix the higher or lower, whatever it is.
that is why, sir, normally like financing for our organization can comes from both debt cost also, equity cost also.
Correct.
So that means we are also depending upon the external organization like banks or another financial institution. So they have their own standard of discounts, no sir. Like for example, their interest rate. So based on that only our rate can also be varying.
Okay.
It cannot be fixed like maybe for me a cost of investment is different from your strategy of cost of investment.
So basically, bank is not deciding factor. Deciding factor is the company only, and company is seeing whatever we want to give to return to bank. This plus our own
Yeah,
margin.
yeah,
Is it?
correct sir, that is the
Okay. And for a
that is the,
cash-rich company where they are not taking any loan from the outside because company is already cash-rich, this is solely depend on the company policy.
company, yeah, solely
Okay.
depend on the company only.
Okay. Thank you.
Similarly, for the yeah, for the IRR also, it is like internal rate of return that is described in terms of percentage points.
Okay.
But
So
sorry to interrupt here.
Yes, sir.
Even if a cash rich company also, what we calculate is the amount that is being used as working capital. So what is the return? So we calculate interest for those working capital usage also then.
Yeah,
So decisions
correct,
are
sir.
taken based on working capital usage. Like when the management means when the board is investing amount into the business, so we always calculate the bank interest. Though company is not borrowing any money from bank, but the invested amount has some interest to it.
Yeah, correct,
No,
So
sir.
sir.
always we figure
Actually,
out
One,
Ramakrishna,
those interest
sir,
rate into this.
here थोड़ा सा मेरा alignment ये है कि because company has company is cash rich and they are using own money, so then there is a strategy to play whether they want to go for the project or not on even the lower IRR. Maybe suppose the company fix IRR 10% or 11% or 12%, company can go depend on the strategic initiatives for looking of the
Yeah,
future
there,
business.
there we have that question of deciding on which what is the
Correct.
percentage that company needs to agree.
Correct.
yeah,
Whereas when
that
in
is
terms of
that
borrowing,
is
we
why
don't have
we
cushion. The slab is fixed.
Yeah.
So that is why we as a leadership position, we need to understand these concepts so that we make a better informed decision. Yeah. Like if it is strategically feasible or strategically we are making more value for our organization. If we understand this one, then we are making a better decision.
Right.
Similar to the NPV decision rule, accept the IRR when it is more than like more than actual required rate of return. Then NPV versus IRR. Like what is the difference we can say? Like for example, NPV it shows absolute value created in money terms, whereas IRR it shows return as a term of percentage. So it is good for maximizing enterprise value, but IRR it shows easy to compare against the hurdle rate. So better for mutually exclusive project choices. Mutually exclusive means it independently we can have decision making choices for this. So it can favor smaller high return projects. So basically we need to understand what is the net present value and internal rate of return. IRR is useful for communicating return efficiency, but NPV it creates value. It tells us a value creation, and IRR as a percentage information.
Sir,
Then
comparatively, I think NPV favors more of large investments or larger projects, and IRR being more dependent on internal, cash rich and self investment kind of a thing is more for favorable projects, small initiatives, wherein it is more easier to calculate the overall. You have overall control and then the returns are calculated and kept in control is what my understanding.
yeah, correct, sir. That is the I think that is the basic understanding of IRR with respect to NPV.
Okay. So they are not comparable actually.
No, we are not comparing it directly, but
Yeah,
at least for our decision making perspective, we
yeah,
need to see NPV means it creates some value in terms of
yeah.
monetary terms.
Correct.
But IRR, it gives us a return as a percentage.
Right, right. Correct.
Then we are going to a cost benefit ratio or benefit cost ratio. We can
What is
say whichever way we can say. Basically, it is a ratio of present value of cost and the present value of the benefit. How much we are getting benefit out of that same cost incurred. For example, if the present value benefits 1.2 million and present value cost is 0.8 million, then benefit cost ratio is 1.5. How we are getting 1.5 is 1.2 divided by 0.8. That means 1.5. That means 1.5 benefit per 1 euro cost. So that how much we are getting benefit out of the cost incurred. That is the benefit cost ratio. Here, like for example, if our company or organization have multiple projects, then we need to see each aspect also. Like for this project A, how much benefits we are getting, how much for the project B, project C. If we have multiple projects, then we are seeing which gives higher BCR, higher the benefit cost ratio. We choose that one as our project. Yeah, like keeping all other assumptions as same. So it is a useful metric, but it is not sufficient on its own. Only if we are seeing only BCR means no. We need to see, like as again I've compared. We are coming back to that. We are comparing equals, like apples to apples only. Not we are taking NPV in one and BCR in one. For this BCR for the another NPV. So if you are comparing that way, then we are getting it totally wrong. Then profitability index. Profitability index is the ratio of present value of future cash flow to the initial investment. Example, if the present value future cash inflow is 600,000 and investment of 400,000, then PI profitability index is 600 divided by 400, that is 1.5. Why we need this PI? It helps rank projects when capital is limited. A PI profitability index greater than 1 means it's expected to exceed the investment. If the profitability index is equal to 1 means we are just creating value which is equal to the investment. If it is less, that means investment is more, but we are getting less value. So why we need to understand this means it helps to identify the value created for every investment we are making. So still we have more like risks, dependencies and capacity constraint. These all can be there, but still we need to understand as a like concept what is a profitability index means. It is the present value of future cash flows to the initial investment. How much we are investing and the present value of the future inflows gives the profitability index. Then discounted rate and hurdle rate. Discounted rate means required rate used to convert future cash to today's value. So discounted rate again, it is a management assumption that about that required return and risk. If the project risk is higher, the organization may demand a higher return. So this is where finance and our strategy meet. Not all cash flows deserve the same level of confidence. So discounted rate reflects cost of capital, inflation expectation, risk and opportunity cost. Example, a low risk operational improvement may use 8%. A risky new market project may need a higher hurdle rate. So that is the discount rate and the hurdle rate. Then we have weighted average cost of capital. So weighted average cost of capital means every organization has a cost to access money. So that is the cost of capital. Every organization has a cost to access money. Even internal fund have an opportunity cost. Like even cash rich company can be termed as that for using that internal fund, we say it as an opportunity cost. When projects are evaluated, they must earn more than the cost of money used to fund them. That means even the cash rich company, if they are using the internal fund, the project's outcome, when it is evaluated, it must be earning more than what we are investing, that what we are taking that fund to use. So that is the weighted cost of debt and equity financing. WACC, weighted average cost of capital, is weighted cost of debt and equity financing, that is often used as a baseline discount rate because it reflects how the organization finances itself. Example, if the business funds projects through loan and shareholder capital, then weighted average capital cost of capital blends those costs into one rate. Even though we are taking money from like internal and then through loan and then shareholder capital, we are taking as a like a weighted average of total cost of that capital. Then sensitivity analysis. Sensitivity analysis is we are changing one assumption and observe the impact on value so that we find which is more suitable for our organization. Example, if NPV turns negative when volume drops by 10%, the project is highly sensitive. For example, if the project B, if turns only like if it turns to zero when the volume drops by 10%, means it's like less sensitive compared to the project A. So similarly, we can use it if it is compared with the volume, if can be used with the price or cost or discounted rate, adoption rate or productivity gain. We can use different criteria based on our organization's working strategy. So sensitivity analysis shows which assumptions matter most: volume, price or cost, timing, discount rate, adoption rate. This is important as leadership decision making side. The goal is not to prove that business case is right. The goal is to find where it can break. For example, here, if the risk is higher, then it is moving to a more sensible, like more sensitivity criteria. So higher the sensitivity criteria, then we have a tendency to reduce that selection of that project. So we need to have which is less sensitive to our based on less sensitive, we take decision here. Then
So,
scenario also
we are
can say.
talking about nervousness, sir, basically.
Nervousness means like again we are comparing in various criterias. We are checking
Right.
for the risks also. If the risk is higher, then it is higher sensitive. If the risk is comparatively lower, then it is less sensitive for our project.
Right.
Then next we are
Got it.
seeing about scenario analysis. So we always say about best case scenario, worst case scenario, no? So this is scenario, it is broadly based on that sensitivity. Baseline, most realistic planning assumption used for approval and monitoring. In the best case, we get a higher benefit, lower cost, faster adoption. We are showing upside potential. Same in the worst case means we get lower benefit, higher cost, higher delay, and we are using for that resilience testing and contingency needed. So based on that sensitive only, we are creating a scenario in the best case scenario or in the worst case scenario, or it's a baseline scenario. Why we need to understand this means we need to have a contingency fund. Like if in case of something going wrong, then we can use the contingency fund or contingency planning or the management reserve for that our projects. Then expected.
Sir, typically, sorry, sir. Typically, the contingency, allocation is about, 10 to 15%. Yeah, generally about 15% of the overall project cost or something like that. Generally speaking about, there could be variations.
We keep this contingency fund not like something with our like analysis of our project cost. Yeah, we are keeping that one for the risks, uncertain risk. Yeah, which is not considered in our project. So
essentially the delays, sir. Essentially delays. Contingency generally goes into delays, basically.
Delays.
But my question is, if contingency, we put about 10 to 15% of the overall effort. Generally, if I look at it from a software development project kind of a scenario, if I estimate it to 10% or 15% of the overall effort that is required for a product development. But if I have to look at the scenario analysis, what happens if the contingency is absorbed, and because generally there are always unforeseen situations and delays are there. So how do we look at the sensitivity analysis, or the best case scenario kind of a thing in those situations?
Yeah. So mainly this scenario analysis is broader than sensitivity analysis. So instead of changing one variable, it combines several variables into plausible future. Here example, best case, you can say higher benefit, lower cost and faster adoption. In worst case, we will have the opposite, like lower benefit, higher cost and delay. Where we are needing this contingency is in our executive decision. Scenario thinking supports better contingency planning and avoids a single number overconfidence. That is why we are having this contingency fund. If our planning is also like not moving in the same direction, then we can use that contingency fund to maybe we are bringing it to on track.
We can look at it like a overall risk scenario, we can say.
Risk scenario, yes sir, risk scenario.
Yeah, makes sense. Thank you, sir.
Then expected monetary value. Expected monetary value is a probability into financial impact. It helps quantify risk exposure or opportunity value. Example, 30% chance of 200,000 supplier delay impact gives EMV, expected monetary value of 60,000 risk exposure. We need to understand EMV, expected monetary value. It is the bridge between risk and finance. It means probability into financial impact. How much probably that can happen into how much implicate this in the finance. So if we understand this one, we get the expected monetary value. So a risk is not only a red maybe on our dashboard, but it can be converted into a financial exposure. In our dashboard, if we are seeing any red means, then this risk, if it goes wrong, then it will have definitely a financial implication. So to understand that one, we can see EMV. So it helps the portfolio team compare risks across project and decide where mitigation investment is justified or not. So we need to understand what is the expected monetary value of that risk. Then we need to know what is sunk cost versus opportunity cost. What is sunk cost? We already seen in our last session also. Sunk cost means the money spent, money which is spent in our project is sunk cost. It cannot be recovered. So you should not justify continuing a weak project based on the sunk cost. So we have already invested 100,000. So in order to recover that like 100,000, we are investing more means it is not financially like making any strategic fit to our organization. So even though we have a sunk cost, we should not justify continuing it in a weak project. Example, 1 million already spent on a failing system. Then even if there is some sunk cost is there, we should stop it. That is why we need to continually monitor and control whether we need to continue or not. Opportunity cost means the value of the next best alternative solution which is not chosen. It is very important in portfolio prioritization, often invisible in project debate. Example, funding project A means delaying project B. So we need to check whether this opportunity cost is making any value to our organization or not. So this is very important like for decision making. Many organizations continue weak project because of the sunk cost, but we need to always come back and then review it, whether we need to continue and making better decision making instead of so much of sunk cost. Then
We also
depreciation.
use opportunity cost sometimes for even for cost of poor quality and also lost opportunities sometimes.
Yeah, that is also
We use it
included.
actually, yeah.
Yeah, correct. Depreciation, annual straight line depreciation, asset cost minus residual value over useful life. Depreciation, actually we can take it as a in simple terms we can say that cash leaves when the asset is bought, but accounting expense is recognized over time. So that can be said about the depreciation. Depreciation spreads the cost of a long-term asset over its useful life. It affects accounting profit, not the original cash outflow timing. So, for example, a machine costs 500,000, a residual of 50,000, its useful life for 5 years, then annual depreciation is 90,000. So, we are taking as a like annual straight line depreciation. In real, it will be changing based on the discounted rate also, but we are not complicating it. Just we are taking as annual straight line depreciation. This we need to understand depreciation in order to inform in our like profitability, reporting profitability, tax and asset planning, all that. For all that purpose we will be using depreciation. Then working capital. Working capital is the value of current asset minus current liability. So a project can have strong ROI, return on investment, but still it can create cash strain during ramp up. Then here that time we need to have like what is the working capital, how much is the current asset to how much is the current liability. Project can consume cash through inventory, receivables, spare part, ramp up stocks or delayed customer payments. Example, a new product may be profitable but require 300,000 extra inventory before customer cash arrives. So that means that is the cost of the working capital. Then equivalent annual cost, EAC, equivalent annual cost, that is the NPV of costs converted into equal annual cost. Example, a machine A lasts 5 years, then machine B lasts for 8 years. That means equivalent annual cost means it helps compare the yearly economic cost of each option. Just we can understand which EAC helps comparing the yearly economic cost of each option. So basically sometimes what we do is we are comparing only the purchase prices, but if we are comparing only purchase prices then it will be incomplete. So a cheaper asset with shorter lifespan and higher maintenance may be more expensive annually. So EAC supports lifestyle like life cycle thinking rather than the purchase price thinking. It helps comparing alternative with a different lifespan by converting cost into a comparable annual figure. So this just we are taking this to understand how we can plan our portfolio. Then cost of delay. Cost of delay means it is the value how much we lost by delaying delivery. Cost of delay converts schedule slippage into economic impact. It is useful when prioritizing scarce resources. Example, if a product launch is expected to create 80,000 monthly contribution, a 3-month delay will cost economically like 340,000 for us. So how much we are losing the value for the delay in delivery, that is the cost of delay. This concept, cost of delay, is very important in our portfolio management. sometimes like we ask which project is the cheapest and which delay hurts us the most. So based on that answer, like how much delay we are allowing, that cost of delay, it helps us to prioritize urgent strategic value or revenue generating work that makes scheduled decisions financially viable. So based on the cost of delay, also we can prioritize how much we are allowed for delay or how much we cannot allow delay. Here one case study, we are comparing 3 projects. One is a organization going for an automation project. Like we are investing 500,000. We have an NPV of 220K and internal rate of return is 18% with a payback period of 3.5 years. How we can understand this one is, we are having a good positive NPV. So this project creates value for us. Higher and IRR is there. So that is also very good. Payback period is 3.5 years is also very good. So in any case, we can choose an project A. Then project B means higher investment than project A, but higher NPV and lesser IRR, and payback period is 5 years. So it gives higher value but more risks and slower return. And third, compliance. For compliance, we are investing this much, 300,000. But even though it is low and negative, and if we need to see, it may be mandatory despite the weak financial return, because it is part of the compliance and we need to invest it. So C is mandatory, and for if we are choosing automation or new market, then based on our strategy, we can choose project A because we have a lesser payback period and we also have a solid value. We can, like for example, if our strategy is only reaching new market, then we go for the new market instead of automation, but we have a higher value but more risk. So we need to see which option is best for our organization, and we choose that metric and we select that project. Again, we have learned all that concept, but we need to understand the concept rather than like knowing the formula. Yeah. So basically, return on investment, how we are using is, we are comparing the return compared with the investment. Payback period means how much time we are getting to recover the investment. Net present value is the absolute value created today. IRR is the percentage rate of return of the project. Then BCR, benefit cost ratio, is benefit per euro of the cost, benefit per money spent for the cost. Then break even means it's a minimum volume needed. So this is the summary. This, as like we are not I'm not is going into a financially like a good thing, but we need to understand as a basic concept for making decisions.
Sir, in the previous slide, you've given 3 scenarios before this, sir.
Yeah.
The
Basically,
Yeah,
how we
here,
are
yeah.
arriving at our portfolio decision, sir.
So here, this is not like, we are not comparing 3 scenarios and, there is no prudence in trying to avoid. These
Correct.
are mandatory situations which are inevitable, but still
Yeah.
only we are calculating them in terms of, the financial, project financial aspects and categorizing them. That's all.
Yeah. That is why our financial literacy, this
Yeah.
tool, it helps, supports our judgment.
Right.
We understand, no sir, like if we know the understanding like of our financial concept, for example, if we know NPV this much, IRR this much, payback this much, then we can interpret our numbers to make a
Correct.
judgment. Yeah. So they are not replacing the project, but we are understanding how much value it creates or how much value it does not create or how much we are losing. We can understand, no sir.
Right. Right.
That is
Absolutely,
why
sir.
our financial literacy comes into picture to making a clear decision. Yeah.
Yeah. Yeah.
Just
But
like
in
for
a
understanding, like
scenario.
prioritization.
Right, right, right. In a situation like for the C scenario, sir, compliance situation,
Yeah.
then it actually there is no IRR, there is no payback, but it is a mandatory requirement.
Mandatory
So even if it is a negative thing, we have to go for it. Only it helps us in terms of how much is your financial commitment and the
commitment.
cost which has to be rounded off on overall expenditure or something like that.
Yeah. So we are understanding in terms of financially our portfolio.
Right. Got it, sir. Yeah.
So again, this one. Yeah. So common mistakes in our financial business cases. This is just a practical, maybe not a warning, but maybe a flagging, red flagging, we can say. So we can count benefits without clear ownership or measurement method. That can be a mistake. Yeah. So ignoring ramp up time, change adoption, or working capital, using ROI alone without looking at cash flow timing, that can be a mistake. Yeah. Then treating sunk cost as a reason to continue weak project. These are all some common mistakes. Assuming the base case is guaranteed rather than uncertain. So we as a manager or a leader, we need to challenge our like benefit ownership by understanding our financial implication in our portfolio. So that is the important thing. How these concept prepare for a portfolio financial tool? We see budget set the approved funding envelope. Budget means we are having a total financial implication that can be used for our funding of our project. Yeah. Forecast means we are forecasting show the expected landing position at some point of time, like after 3 months, quarterly or half yearly, it it will be in our project, that can be forecasted. Return on investment, NPV, IRR, and payback, it support the project comparison. Risk adjusted analysis improves prioritization under uncertainty. Benefits tracking ensures approved value becomes delivered value. So this totally, it can be considered as a loop. We need to understand what is budget, what is the forecast, and if we know some basic financial concepts like ROI, NPV, IRR, they can use it for comparing the projects. Then we are also checking with the risk adjusted analysis, like sensitivity, how much sensitivity or scenario based on analysis. Then we are also going for the benefits, how much benefits we are getting for which project. Yeah, based on that we can take decisions. We can do the review and monitoring, or maybe corrective action also. So based on this we can take actions. The main key takeaway here is financial metrics are not the decision, they are the decision evidence. Yeah, we are getting a data. From this data we are making a decision evidence. A strong portfolio conversation combines value, risk, timing, affordability, capacity, and strategic fit. Mainly we are understanding this financial concept for making a data point which can be understood by everyone, and then taking a professional decision making. Yeah. So also it is transparent with this data.
When we
This
are
is,
saying it is decision evidence, we are validating whether the decision is a good decision or questionable decision or things like that,
yeah, basically
based on the risk
understanding
taken and risk
and then moving
realization.
forward. Yeah, correct, sir. So this is the financial concept. Now we will move into the portfolio project. This one, I will open that one. Yeah. Project portfolio financial tools. Like as we see that ROI, NPV, IRR, that all can be used for our budgeting, forecasting, value, risk, prioritization, and overall governance. So in order to understand that only, we see that financial concepts. So here we will see how the sessions how that financial literacy helps in our portfolio project management with financial aspect. So here we are not going into a expertise or specialist in the financial aspect, but we are understanding how this create value for our organization. So by that lens, we are seeing this one. So we are understanding, then we are evaluating financial value, benefit, and risk. After evaluating, we are prioritization. We are using prioritization logic for funding decision. Then we are going to monitor. After prioritization, we are selecting, and after selecting that project, we are monitoring that portfolio health through dashboard and governance, and then that translate financial data into corrective action plan in our project portfolio. I think we need to understand whole life cycle of this. We need to understand portfolio level budget and forecast. After understanding that one, we need to evaluate. After evaluating, we are prioritizing, and then after prioritization, we are selecting a project or portfolio, and then we are funding it. After funding, we are monitoring, and then translating that data into corrective action if needed. So can we afford this portfolio? How benefits are in our project portfolio happening, and then who will be receiving the funding first, second, third, and then how or like where do we need to do some corrective action. This all we will understand that. What portfolio finance means. As we all know, we have limited capital and limited resources, and then we are using that same capital and resources for all our portfolio projects. So comparison of project with different benefit, different risk, and timeline. So if we are comparing that one, then we are control of budget, forecast, cash flow, benefit, and exposure. Then we are making decision support to start, continue, pause, or accelerate or stop choices. So this is where our financial literacy comes into effect. So the project budget asks how much one project will cost. Portfolio finance asks whether this project deserves funding compared with other demands. For example, automation project or compliance project and a new product launch, that can be compared with the cost alone. But if you are comparing with cost alone, we will find a different decision. Whereas if you are comparing with the value, risk, and our strategy, then we will come with another decision. So based on that, our strategy, we will move ahead. Why financial discipline matters. One example I could say, an ERP upgrade, enterprise resource planning upgrade, quality improvement program, or a customer portal capacity expansion may all be have a valid projects. The problem arises when they are approved together without funding pattern and resource reality. So financial discipline avoids this situation where every project is approved, every project is delayed, and no project delivers benefits on time. So that is why we understand as financial discipline. It prevents approval of more work than organization can fund or execute. It exposes weak business cases before execution begins. It makes executive trade-off visible and fact-based, based on the numbers. Yeah. Then connects strategic ambition with measurable financial outcomes. It protects the organization from hidden overload and value leakage. Funding envelope. Here, like with an example, I could say a company may announce a 10 million transformation budget, but 3 million is already committed from last year. 2 million is a mandatory compliance. So if we are considering with this 10 million and then 3 million from last year and 2 million is mandatory compliance, means it's already 5 million gone. Yeah. So the real discretionary envelope is like 5 million. So this changes the prioritization conversation. So funding envelope means defines the total amount available for a portfolio period. It separates committed, mandatory, discretionary spend. It includes contingency and management reserve logic. It creates the boundary for prioritization and trade-offs. It forces leadership to discuss affordability before preference. So we see this as a envelope pattern. What is portfolio budget versus project budget? We know projects are the smallest unit, and multiple project can come under a program, and multiple program can come under a portfolio. So what is a project budget? Project budget means we are funding a project only to create one certain value. So for only approved cost for a specified project scope. But portfolio, it may be a total investment across many project and program. So project budget means for one value, portfolio means across many projects or programs. So it's a total investment across many project and program. So project manager controls delivery within the approved project budget. Portfolio manager controls funding allocation across all project mix. So project can be on a budget while the portfolio still underperforms. So I think we can make a easy distinction, this one. Project budget versus portfolio budget. Then we have already seen the capex and opex. Capital expenditure in terms of long-term equipment or long-term asset for our organization, and opex is the operating expenses that includes consulting, licenses, training, and operating support. Internal labor. Internal labor can include engineering, project management office, IT, and operational effort. Even the shop floor also considered as internal labor. Then contingency is the allowance for known uncertainty. Management reserve is central funding for portfolio level exposure. If you are considering as a manufacturing company, manufacturing organization's example, a robotic automation project may include a capex for equipment, OPEX, operational expenses for the integration support and internal engineering labor, and contingency for maybe commissioning risk. Then we have some management reserve for the portfolio level exposure in case of some unknown thing in our robotic automation. Then we can use that management reserve for that. So mostly we consider as internal labor as free, but in portfolio management it is a scarce financial constraint, because maybe same resource, same expert SMEs can be used for many projects. Then they may be unavailable for another project at the same time. So we need to cost it based on our capex, opex, internal labor, contingency, and management reserve. We need to see through all these three lenses, like capex, opex, and internal labor. Capex decision affect investment approval, depreciation, and asset strategy. OPEX decision affect annual operating cost and run rate affordability. Internal labor affects capacity, delivery speed, and opportunity cost. Good portfolio finance shows all three views together. Hidden labor demand is one of the biggest reason portfolios slip. For example, a project may look affordable in cash terms, but may consume 40% of the automation engineering team for 6 months. So that opportunity cost must be visible. One more example I could say is like two projects which having similar cost, but one needing scarce resource, internal resource engineering, may be harder for a portfolio to observe. So in that case, then we need to choose which can be traded off, which project can be taken, which cannot be taken right now. So based on that decision, we can move. Then portfolio baseline. Approved reference point for cost, schedule, scope, and benefits. That baseline, portfolio baseline we are creating for cost, for the schedule, for the scope, and the benefits. Combines approved project budgets into one portfolio view. Enables comparison of budget, actual, forecast, and variance. Must be formally controlled when assumptions change. Without a baseline, portfolio reviews become opinion debates. If scope is added like informally, then if you are not in the change management, then portfolio can always have a higher risks. So we need to measure it like have a constant thing, so that we have a approved cost baseline or a schedule baseline or a scope baseline and then benefit baseline. Any changes needed, we need to go through the change management and then we need to change the baseline accordingly. So
Sir,
this
how
is
frequently
basically based for
are
the governance of that portfolio.
yes, sir. One quick question. Sorry, I'm interrupting. How frequently is portfolio baseline updated, sir, for relevance to the overall portfolio management aspect of it?
Yeah, normally, sir, normally we go through a quarterly or a half yearly timeline, because at portfolio level you are not making decision day to day. Yeah, but
Right.
if you are continuously reviewing and monitoring quarterly or at least half yearly, so that we check it and change it based on that review. Only half yearly or quarterly, sir. Minimum time is quarterly only.
Okay. But there are so many variations happening in because we are talking of
Multiple
delays.
projects, yeah.
Yeah, multiple projects and delays and NPV and IRR and various other parameters which show cost of quality and those several aspects of it. So if you are looking at a quarterly or a half yearly basis, then is the baseline for a portfolio helping us in generally, I mean, when I say us,
No,
generally the
basically it helps
organizations.
this leadership to be in control, sir. They will
Okay.
not lose control if we are if there is any informal change, informal request for change. If we are not updating, means we are losing the control.
Okay.
If we are updating, it means we already know that there are some changes and we need to make some changes to be on track. So in order to keep that leadership in control, we are always updating our baseline, yeah, through this governance.
Right.
So the baseline basically it keeps our facts stable. So if there is any deviation or variance is there, we can come back to the control and we are taking measures to govern this baseline, yeah, portfolio baseline. Budget approval gates. So first we are taking budget. Maybe we can say through its life cycle of this portfolio, we can say about five stages. Like in the case of a business idea gate, a small funding for investigation or discovery. This is maybe an idea gate or a business need gate. Then second, business case gate. We are validating value, We are validating the cost and risks and assumptions. Then we are going to the funding gate. Funding gate where we are allocating maximum budget within that portfolio envelope when we are starting to execute it. Then continuous gauge. It check whether the project still deserves funding. Here we are going for the continuous monitoring and execution, like monitoring and control level. Then final closure gate. Confirm cost, benefit, lessons learned. If you are going similar to a life cycle, at the starting idea gate, then we are doing a business gate, then we are funding gate, continuation gate, and closure gate. So this this is maybe a one time case, we can say. Normally in organization it can happen in multiple way also. Maybe idea gate and business case gate can be clubbed together, and then funding and continuation can also be clubbed together. It is like one case, but it may not necessarily follow the same pattern always. Budget, actual, and forecast. Budget means the approved financial plan. Actual means how much we are already spent or incurred. Forecast means expected future spend and final cost. The variance means difference from baseline and current forecast. So managers need forecast insight, not only historical actuals. So maybe we can see this analogy as a windshield analogy and a rear view mirror analogy. If we are seeing windshield means how much we are going in the forward. For that we can see as windshield, and how much we have already completed actual, we can see rear view analogy, rear view mirror, we see how much we have spent. And for forecast we can say expected future spend and final cost. Example, a project may have spent only 40% of budget, but if supplier prices have increased, then forecast can go 25% overrun. A portfolio already has a final decision to make. Yeah, so that is why we are keeping monitoring of that variance always, how much we are moving from the baseline. Forecasting methods. We have several forecasting method. The classic forecasting methods are like bottom-up forecasting from work packages. We are forecasting for each work packages, and from work package to the project, and we are from projects to multiple projects, then we are going into the portfolio level. Similarly, we can have forecasting for trend forecasting using burn rate and productivity. Milestone forecasting based on completed deliverables. Scenario forecasting is using best scenario, likely or worst scenario. Then rolling forecast updated every review cycle. We have multiple forecasting method. This forecasting it matures based on the progress of the project or the portfolio. So early in a plant relocation project, forecast may be based on vendor quote and high level assumption. Later, when the forecast is based on the installation progress, trend, and then productivity. So the best portfolio review combine cost forecast with the physical progress. So it is based on our organization strategy, how we are forecasting it, or how, but we have some methods like bottom up forecasting, trend forecasting, milestone forecasting, so scenario forecasting, or rolling forecast. Then we have a concept of EAC. EAC means estimate at completion. Then ETC, estimate to complete. VAC, variance at completion. These three terms it gives a practical idea of how much we are funded in our project. Like estimate at completion, EAC means estimated at completion, that is expected total cost when the project finishes. That is the estimate at completion. Estimate to complete, ETC means it is expected remaining cost from today. Variance at completion is expected final overrun or underrun. Why we need these concepts are, it is useful when aggregated across programs and portfolio themes. It supports decision on reserve, rescope or stop action. So example, if a manufacturing project has a budget of maybe 1 million and current EAC estimated completion is 1.25 million, then the portfolio board or a portfolio manager must decide whether to observe this maybe 1 to 1.25, no, 2.25 million, the 25 million overrun, we need to observe it, or we need to reduce the scope, or we need to release it, or we can maybe we can cancel some lower priority initiative. So we can if we have this data facts in our hand, then we can easily make a decision what we need to do, whether we need to reduce its scope, or we need to absorb this overrun or this variation. So or maybe we can stop a lower priority initiative. So if we understand this one, we make a decision based on the numbers. Then cash flow timing. Affordability depends on when cash is needed, not only total cost. Large procurement payments can create quarterly cash peak. Delayed projects may shift spend into another fiscal year. Cash flow visibility supports finance, treasury, and executive planning. Portfolio sequencing can reduce cash pressure. I'll give an example. Two projects may both cost 2 million, but one needs 80% payment in quarter one for equipment procurement, while other spend gradually. Then total cost is same, but cash pressure is different. Yeah. So portfolio managers should ask when money is needed and how much it is needed. So based on that, we can make decision. So cash flow, this is about the cash flow timing. Contingency and management reserve. We already discussed about the contingency and management reserve. Maybe I can clarify on misconception what is contingency and management reserve. Contingency, it covers known risk and estimating uncertainty, but management reserves covers the broader unknown or portfolio level exposure. So example, a plant modification project may hold contingency for installation risk, while the portfolio board hold management reserve for inflation or supply chain disruption affecting several projects. This clear distinction is understood, no sir? Contingency and management reserve. Contingency is kept for known risk, whereas management reserves, it covers broader unknown or portfolio level exposure.
Sir, but if management reserve is addressing inflation related stuff, for a 1.5 year project of a capex investment, then by considering inflation, we are more or less ruling out any management support, isn't it, sir?
Yeah, mainly contingency covers known risk, but management reserves, it covers unknown risk.
Yeah, but when you say unknown risk, for example, as I said, about 15% is a contingency for for any delays or commitments, risk commitments. What is allocated percentage, sir? Any number is there out of the overall project budget for management reserve in terms of a portfolio?
No, sir. Actually, we cannot fix this much percentage for a management reserve. This is based on the organization's strategy only, sir. For example, like the concept is clear. If we mean contingency means we are understanding there are some risks are there, and based on that risk we are having contingency measure. But management reserve means we have it includes a broader classification, and we also cover for the unknown level risks. Mainly that is the broader level aspect, sir.
But
But we cannot
if
fix it to a number, maybe 10% or 15%, we could not say, because based on the scale and size of the organization, it may vary.
yeah, but what I'm trying to understand is finally it has to come to a project financial
Yeah,
kind of a number, metric, basically financial
yeah,
number.
yeah,
So that it will fit into any of these ROI
yeah,
or NPV or whatever person the parameters we are measuring. And since we are looking at very broad level parameters, possibly maybe 2% or 1%, or at a broader
yeah,
perspective, there has to be some number allocated for management review reserve, so that in case of a increase in the project cost or overall portfolio cost, some allocation or some savings, some buffering is possible when you combine it with the contingency. For example, if contingency is 15% and you get a you scrape up you kind of scrape up another 3% from management reserve, you get a
yeah,
18% of overall risk coverage or something like that.
yeah. We can, yeah, that is possible, sir. The main aspect is here, we will make decision whether to observe this cost or to reduce the scope, or maybe we fund it and we continue.
Okay.
Mainly we understand this one based on our financial aspect, and then we
Yeah.
can make like, for example, reserve is a disciplined protection, not a hidden padding. So we make decision, and we support that decision based on our reserve. Yeah,
Okay. Oh.
yeah.
So that our decisions are
Governed
well covered or
basically.
well protected or something like that.
Yeah,
But
Got it.
contingency,
Got it. Yeah.
suppose generally in any project we are taking 5% or 15%, whatever it is. So contingency, whatever the project we have, whatever budget we have allocated, over and above, we are keeping 5% for a contingency, that will plus minus, we can use this, right?
yes, sir.
But for the management reserve, actually, this term may be the purely financials. We have not well versed of this. This is totally, I think, is a management decision whether they want to tell the portfolio manager, okay, this is the your management reserve, or this I don't heard many times. This is very limited times we have heard this term. For
Correct.
regular
Correct.
projects, I think people are not using it. Maybe the strategical projects, maybe petrochemicals or something, people may be using. But for FMCG industry, I don't think that we are using. So we are very less exposure in the management reserves.
Yeah,
And it also
actually,
seems
if
only
you are
relevant for
seeing from,
portfolio level, sir. Sorry,
yeah,
sir.
we are
It
seeing about
only
the
looks,
portfolio
yeah,
level, correct, sir.
yeah.
Yeah.
At portfolio level, it makes relevant because at project level, only contingency is
Contingency reverse, yeah,
Can
most
do it.
often used. Yeah,
Yes,
yeah,
exactly. Yeah, Praveen, I think we are
right,
ready.
right, right.
We agree.
yeah. That is the right
Because of
term,
the
sir.
roll up,
Management reserve
it is
means it is
happening.
for
Yeah,
the portfolio level and
Right.
broader unknown risk. But
correct,
contingency
correct,
means we already know this can slip into a creep. Yeah, project
correct,
creep.
correct,
That for that one we are for overcoming that one we are using contingency reserve.
correct,
But
correct.
any management is just declaring this is your management reserves for any portfolio, general practice.
And normally they have this fund reserve, but not it is exposed to regular project works, sir. It is not expected to put in our regular projects, but we have as a management reserve to cover some unknown costs.
Okay.
Financial early warning indicator, we all know if we have some variance from our scheduled forecast variance increases for 2 or more review cycles, then this is an early warning for us. Yeah. For example, a software project reports 60% budget consumed, but only 35% functionality accepted. That means there is a variance is there. So if we are, when during review, if we are seeing only 35% of functionality accepted but 60% budget consumed, means this is not only a cost issue, it also gives signal for the productivity and scope. So based on this understanding of this numbers, cost numbers, based on that we can also see these are some productivity or the risks on the scope. Yeah. So forecast variance increase for 2 or more review cycle. That means it's a early warning indicator for our project or portfolio level. So actual spend rises faster than physical progress. That means also it is an early warning that we need to review it. If the contingency is consumed without a risk reduction, then we need to review and come back for a corrective action in our portfolio. So benefits are delayed while costs continue. That means we can always make some decisions, and so that we are making it the portfolio back on track to make some corrective actions and coming back to it. So multiple projects depend on the same scarce experts or vendors. These are all some early warning indicator from our financial aspect, so that we need to make some changes at the portfolio level. So we keep it not waiting until the final overrun. Yeah. So we see all these variances from our review, like quarterly or half yearly, and from that we already taking decision based on this early warnings.
Sir, it could also be not necessarily same scarce experts and resources, but scary experts and vendors maybe.
Yeah, yeah, correct. Yeah, yeah. That's a important risk. Yeah. Business case essentials.
And even a scary portfolio management also a very good big risk.
Yeah, scary portfolios also. Making a film out of a cash-rich company.
Yeah, yeah. So business case essentials. So business case is a decision document. Yeah. So before we are going into a portfolio level, we are seeing our business case and how our strategy. It is not only a sales document. Yeah. So we are having all that problem or opportunity being addressed, our strategic fit and expected business outcome, cost estimate, funding requirement and resource demand, benefit estimate, timing and confidence level, risk assumptions, dependencies, decision option. These are all need to be in our business case. Yeah. So that we if there is any changes in any of the thing, like in case of, for example, in risk, if there are any risks apart from the known we have mentioned in our business case document, then we need to when we are doing any review, then we need to incorporate the new risks also in this, so that our assumptions or everything is based on our judged our portfolio. Then types of portfolio benefits. If we understand the financial implication, then we also see financial saving, like how we are going to scrap or how overtime, energy or maintenance reduction. So we will see all the benefits, like all the benefits are not same across all the portfolio or projects. Some may have like more scrap or overtime or energy or maintenance reduction. Based on that, we will have financial implication, which in turn can have financial savings or overrun. We can also understand about the revenue growth, new product, market or customer expansion, cost avoidance, risk reduction, strategic capability. So we can see different benefits from this financial understanding of our portfolio. Again, we have seen already the return on investment, payback, net positive value, IRR. So this again, I'll touch upon this. ROI compares return with investment in simple terms. Payback shows how quickly investment is recovered. NPV converts future cash into today's value. IRR estimate the percentage rate of return. So no single metric should dominate portfolio decision. We are all having all this decision, all the information, so that we make the best use of all these metrics. Benefit realization planning. Separate project deliverables from business outcomes. Assign a business owner for each major benefit. Then define baseline, target, measure method and frequency. Track benefits after go live, not only during implementation. Then close the value loop through post implementation review. Benefit confidence. High confidence can give measured baseline, clear owner and tested assumption. Medium confidence can give a reasonable estimate, but dependencies remain. Low confidence means concept level benefit or weak evidence. So portfolio ranking should weigh confidence as well as value. So large but uncertain benefit should often receive staged funding. Two projects claiming, for example, I'm saying two projects claiming 1 million benefit. Like one project for in our manufacturing is like compressed air leak reduction, back metered energy. Other is new market revenue based on early assumption. So both may be valuable, but their confidence level may be differ. So sorry. So we can understand based on our benefit, but also based on our evidence quality. So based on that, we can say we can categorize as a high confidence, medium confidence, or low confidence. So based on that, we can make choices of that.
Sir, medium confidence means how much confidence you are just. What is
No,
high
we are
confidence?
comparing it like relatively. If we are giving some number, then we can understand this much of confidence. We are giving like relatively, it is reasonable estimate, but dependencies remain. That way we are comparing, sir. Low confidence, medium confidence, or high confidence. Not only this confidence level, we can also make like dashboard, like which is can categorized as green or yellow or some red. Yeah. So based on that, it is based on our own benefits only. How much benefits we are taking. So we are comparing based on that. Cost of
Sir,
delay.
tested assumptions, sir. Sorry,
Yes, sir.
sorry, sir.
Yes, sir.
Tested assumptions. When we say tested assumptions, what do we mean? In high confidence, in the previous slide, you said clear owner and tested assumptions. What does it mean?
For example, if we are assuming, if we are assuming this much benefits we are reaping out of this one, but how we are, whether we are whether we are really achieving that one or not, we are testing that assumption, whether our assumption is correct or not, which
Sir,
can be
it is an
tested based on the
assumption.
data.
Sir, it is an assumption. How do I test an assumption? Because I am kind of forecasting it as an
Yeah,
assumption. So
yeah.
I'm trying to understand, or kind of a scenario of testing and a forecast. Is it kind of a modeling exercise, or how is it, sir? When you say tested assumptions, I'm not able to
No,
comprehend.
that means, like in simple terms, I could say, sir, if we have strong evidence backed by our financial metrics, then we can say this one is a high confidence. Not only go with the tested assumption, sir. If we have
Okay.
weak, if we are going with
Okay.
a weak evidence, that can be given
Mhm.
a low confidence. Yeah. If we have a
Okay.
strong data based, our financial metric is highly data based, then we can say it is a high confidence. That means we have a clear measured baseline, clear owner, and we are using the tested assumption. That's it.
Okay. Yeah. Got it, sir.
Yeah, it's based on the financial metrics only, sir. How much we are getting in our metrics, that's based on that one.
Kind of a
It's
perception we are
kind
getting,
of,
overall
yeah,
perception we
kind
are
of
getting.
like prioritization based on our how we are, yeah, how we are ranking our projects and how we are prioritizing our project. Cost of delay. Cost of delay, actually, we have already seen in our metrics also. It measures the financial or strategic loss caused by the postponement. So how much we are delay, each delay have a cost, yeah, the cost of delay. So it is useful for our compliance, revenue, capacity, and customer facing work. So each cost of delay can become a vital criteria for our portfolio also. So it helps compare urgency across dissimilar projects. It can reveal that a smaller project is more time critical. It supports sequencing decision under limited capacity. One example I could say here is like, for example, delaying a regulatory project, it may create fine. So there, cost of delay cannot be accepted in our portfolio. Maybe a regulatory project is mandatory, so that if there is any delay, that then it can arise in fines. Yeah.
Yeah, in addition to the project cost, you are adding more penalties to your
More cost.
overall
So there is a
commitments,
cost
more
of
cost.
delay also in that. So it also helps like decision maker to avoid approving only the biggest ROI project while missing urgent value leakages. So if we know this cost of delay can lead to fine or some compliance issue, then even though if it is like a smallest ROI, we need to approve that project.
This
Then
also applies
financial,
to projects where you have penalty clauses in the contracts, sir.
yeah, penalty clauses also, maybe
The
force majeure
contracts, sir.
clauses also, yeah. So
Force majeure is
based on that,
still acceptable, but beyond force majeure, any project delays or due to resources or delivery delays and things like that, the client charges a huge penalties
yeah,
on
then
high value
cost of
projects, I
delay
think.
cannot be like accepted in the portfolio level, correct? Yeah,
Portfolio.
but we need to understand that there are some hidden clauses or financial implication for each aspect. So that is the basic understanding of our financial aspect of portfolio management.
Right, right, right.
So financial risk at portfolio level, we are estimating the uncertainty and incomplete scope definition, supplier price escalation and currency exposure. So benefit risk due to adoption, market or operational behavior, dependency risk between projects and shared resources, concentration risk in one vendor, technology and strategic bet. This is like a total, like portfolio risk is not the sum of project risk. That is the basic understanding of this financial risk. Yeah. So portfolio can have multiple risks, but away from the project risk. Yeah. So there is a financial risk, financial implication at a portfolio level, which could be understood from the estimate uncertainty or supplier price escalation, or a dependency risk between project and shared resources, or a concentration risk in one vendor, technology or strategic bet. So if multiple program depend on same ERP data model, a delay in one foundation project can affect multiple benefit across
Projects.
the portfolio.
Right, right.
So we need to understand the financial risks at the higher level. Then risk adjusted value compares expected value after considering uncertainty. Basically, we are considering the risk adjusted value. So it prevents optimistic project from being overrated. It balances return, probability and impact. We are making this RPN, probability number. So we can see can be applied through scoring or financial scenario. It improves funding quality when evidence is incomplete.
Sir, one question, sir.
Yes, sir.
Sir, for portfolio management, you have programs plus
Projects.
further resources which are kind of administrative or support function or
Yeah,
or yeah,
administration. Yeah, yes, sir. Yeah.
you have additional resource commitments. So when it comes to the previous slide, sir, can you go to this previous slide that we discussed? Yeah. So when you say dependency risk between projects and shared resources, you have additional functions which are supporting the portfolio management or program management
Yeah.
over and above the projects. There is an additional cost. And we are talking of risk of shared resources and between
So,
projects.
example, I will say with example, sir.
Yeah.
If multiple program depend on the same ERP data model, okay.
Huh.
So
Huh.
a delay in one project can
Huh.
affect benefit of other project, also the portfolio. So that can be a dependency risk. Understood, no, sir?
Agreed, sir. Okay. Yeah, but that is a schedule related Gantt chart. If you have
Even
a,
is even it is a
huh.
schedule, there is a risk, but we need to see it as a portfolio view. It may not be affecting projects, but in the portfolio, we have some dependency risk.
It might have a cascading effect which rolls up to a portfolio loss or something like
Portfolio level. So that will have a financial impact at the portfolio level.
that. Okay. Right, sir. Please
Yeah.
carry on.
Yeah, okay. Then sensitivity analysis. Sensitivity analysis, as mentioned, this is based for the risks. Yeah. So business case may look attractive, like maybe some volume is achieved, but if we are seeing it in the, say, in the case of sensitivity analysis, it may show that demand is far more important than the tooling cost. So we can say test with assumption most influence the financial case. Typical variables: demand, price, cost, productivity, adoption, schedule. So we can have our sensitivity analysis based on our demand forecast or price forecast or cost forecast. So it identify assumptions that require executive attention. So based on our sensitivity analysis, we can take decision which one to go. It supports go or no go or a pilot or staged funding decision. It reduces the risks of approving fragile business cases. So main aspect here is portfolio manager or a portfolio board can request market validation based on this sensitivity before committing full funding. So we can say we can take decision based on that, and we can support go, no go, pilot or stage funding decision.
Sir, the
Then
commitments are
scenario.
as such. It is when you have things like contingency, um, uh, contingency, percentage
Funding,
and management,
contingency funding, yes, sir.
funding and management reserve and things like that. It is basically the structure itself is staged funding. So. What is the further staging we are talking about at the portfolio level here? Because as such, the project follows a staged
Yeah,
milestone based or a
we
staged.
are we are just aiding our decision, sir. Based on the sensitivity, we can aid whether how much we need to go or how much we are slowing it down. Based on that, we are making decisions. That is why we are just using the sensitive analysis. It's for the broad classification of how much we can do funding.
Further staging, we are saying further split
Yes,
in
sir.
the milestone
That
commitments
means,
or something
like,
like that.
for example, sensitivity analysis may show that demand is far more important than tooling. So based on that, like if we are showing with respect to demand or price, then based on that we can either fund it or fast track it or maybe slow it or staged? How much we need, like more than 20% or 30% we can say, and then we fund it across for that based on our sensitivity of that portfolio level.
Okay.
Scenario planning, as we said, that baseline, base scenario, worst case scenario, and best case scenario. So base case means what is most likely to happen. Downside case, what if cost rises and benefits slip. And upside case, what if adoption or market demand accelerate. Stress case, what if a major dependency fail. Pre-agreed response, improved decision speed. So we are classifying our best case or worst case or downside case. Based on that, we have a different decision making strategy. Here mainly the position scenario planning is kept like a preparation, not as a pessimistic tool. We are not keeping as a like a negative scenario. Just we are having like aware of all the aspect, and then we are going with the scenario planning. Portfolio risk reserve logic. We are quantifying the major financial exposure across the portfolio. Avoid double counting project contingency and central reserve. Hold central reserve for correlated or systematic risk. Review reserve drawdown through governance decision. Use reserve data to improve future estimating maturity. For example, maybe in case of a steel industry or a manufacturing plant, if there is any inflation in steel price, it will affect overall portfolio prices. Several projects can be affected at once. So individual contingency may not fully protect the portfolio. So in that case, a central reserve allows the portfolio board based on the responses with a random cutting strategic project. So reserve should be visible and justified. So portfolio risk reserve logic. That is the logic behind the portfolio level. Then financial prioritization criteria. As we have seen before also, the priority we are making a reference, and then prioritization based on our RPN number. Strategic alignment and mandatory requirement. We are prioritizing maybe based on net financial value and benefit confidence. Risk adjusted return and cost of delay, resource demand, affordability, timing, dependency fit, and ability to execute. So we can have multiple criteria in our portfolio based on like our working and our strategy. We can follow strategic alignment and mandatory requirement or net financial value and benefit confidence. Here, for example, if you are considering only ROI, like return on investment or NPV, then that might not only like it will be alone. With that metric alone, it will not be sufficient to make any decision here. So project may have excellent financial value but require scarce resources, means then we already need to look into our priority, how we are prioritizing in our portfolio. So these are all some of the criteria based on which we can financially we can prioritize our portfolios. Then we are making again scoring model for funding decision. We are having questions like, for strategic fit, does the project move a priority objective or a financial value? What economic benefit is expected from this? Risk and confidence, how reliable are assumptions and delivery? So these are all some of the questions we are asking, and so that based on these answers we are scoring it and then making a funding decision based on that pattern. Again, project hopper and portfolio, we have already seen the project hopper and portfolio funnel. So based on our information, the hopper captures all ideas, demands, and candidate project. Then we are screening. Screening removes a weak or non-aligned proposal early. Then we are prioritizing. It compares value, risk, and urgency. then we are funding it, and then we are reviewing it. So this is again, we are connecting it to our project hopper and portfolio funnel. Capacity constrained portfolio selection. Financial approval is meaningless without resource availability. So critical skills often create real portfolio bottleneck. Portfolio plan can match people, budget, calendar, reality. Again, this is coming back to the how the constraints related to the capacity is mentioned. So based on this, we are making decision on this. Mandatory and discretionary projects. So when we are coming to a decision of mandatory and discretionary, we need to check all the aspect, like whether it is a compliance, safety, or legal requirement. Then if you are comparing to our strategic, whether it is aiding our growth strategy or competitive positioning strategy investment, based on that we are prioritizing it. Then efficiency based on waste reduction, automation, or productivity improvement. The main this segmentation, it improves fairness in our decision making. That is the basic aspect of understanding why we need to have a mandatory or a discretionary project in our portfolio level. So again, stop, pause, or resequence. During review, whether if we are seeing whether even if it is included in sunk cost, whether we can stop or we can pause or we can resequence decision. This all can be taken based on our review of all the metrics. Stop when the value case is no longer credible. Pause when timing, dependency, or funding conditions are temporarily unfavorable. Resequence when cash flow or capacity constraint reduce value. Accelerate when cost of delay or opportunity value is high. Stopping a project can be portfolio success, not a failure. Okay. I think basically we understood about like financial metrics aspect. So maybe we can continue tomorrow. We have only few more slides, so we can continue tomorrow. And we also continue with the maybe understanding of this concept through some more questions. So we'll see this one tomorrow. I think today we have seen more of cost and cost metrics and all that thing. Is it okay, sir? We can continue tomorrow, no, sir?
Okay, sir.
Yes, sir. That should be fine.
Yeah, basically I will come back to that last few slides, and then we will see understanding of our concepts in case of costs and financial metrics. Then we also see about the cost, like dollar, hard dollar, soft dollar, and all that things tomorrow.
Sure, sir. Should be fine.
Basically, we are not going into a financial expertise in this, but we are understanding what is what.
Yes, yes, absolutely. Yeah, yeah.
Yeah. Okay, then have a nice Saturday night then.
Bye,
Thank
sir.
you, sir. See you tomorrow.
Thank you, sir.
Thank you. Good
Thank you
night.
so much, sir.
Good night.
Good
all.
night,
you.
sir.
Good
Thank
night.
you.
Yeah.
Good night. All. Thank you, sir.